Okay, welcome everybody to today's webinar, Division 296, Strategic Considerations for your SMSF clients. Fair to say, it's been a pretty sort of busy few months for self-managed super and more broadly superannuation from an industry point of view. And I did a webinar, firstly through this forum back in Feb, when we kind of got the legislation released on Division 296, and we were then hopeful of what was to come as far as how the legislation and things would work. And not only did we get the legislation in, we got it passed very quickly. There was really no debate. It all happened. So the legislation, as it in itself, passed pretty much as I presented it, or exactly as I presented it back in February. But then we had the release of regulations, or at least draft regulations, in March to cover off on a number of other key areas. And whilst those regulations themselves have not yet been released in a final form, I was speaking with Peter Burgess last week because he was in Canberra to meet with Treasury post-federal budget, which will make up a bit of a conversation as part of today. But Pete assured me that despite the SMSF Association's wishes and intentions and desires and submissions, the government are going to make no changes to the regulations, particularly around the area of death benefits, which is a bit of a topic for today, and how that's actually going to work. So we're ultimately stuck with it. And Treasury's words, probably not their exact words, were it's going to be up to the ATO and the industry to sort out how the payment of Division 296 will occur when a member passes away. So, look, I don't want to put too many spoilers out there for today's session, because we will get into that. But there's a lot to talk about today. When I was catching up with Josh about how and what we wanted to talk about, we were really looking at the strategic considerations of Div 296. So I'm going to spend probably the first 5 minutes just doing a very quick refresh of what the rules are as we know them, and then I'm going to jump into the strategy side of it, particularly around CGT reset, around reversionary versus non-reversionary, and about death benefits, and then contemplating what's next with regards to looking at your clients. So there's a lot of content in today's. Everybody will get a copy of the presentation following the session. I know that question is asked regularly. You'll notice also that my disclaimer is a little bit bigger than normal. I've put the general information piece included in the disclaimer about what I'm talking about today, given the particularly the newness of some of the budget commentary, but also in regards to the fact that I do suggest some forms of strategies as part of today's session. So CGT reset, reversionary versus non-reversionary, death, and what to do with higher balances. That's the crux of what we're going to talk about today. So let's jump straight into it. What do we know? Div 296, we know that it's an additional 15% tax, right? It's an additional 15% tax on the portion of the earnings above the large superannuation balance, which is $3 million, and then a further 10% on amounts above the very large superannuation balance, the $10 million amount there. So it's additional tax levied on the individual on the proportion of the earnings above the threshold. So again, it's all calculation driven. Part of the work's going to be done by funds from an administrative point of view, and then a part of the work will be done by the ATO. Understanding conversations that I've had with others within the industry, there is an interesting concept, an interesting byplay coming about, where we think generally that self-managed super funds are the last to report in the from matters such as total super balance and other elements. But there's a real pushback at the moment based on what I understand through the consultation period with the regulator, that APRA funds will be quite late to the party with regards to recording about who's in scope and who's out of scope. So it's going to be an interesting sort of battle between the two funds from a reporting point of view, which ultimately means that the timing of assessments is a little bit unknown at this point in time. So from a taxation point of view, we know that generally without Div 296, We've got your super fund paying a maximum of 15%, forgetting gnarly, obviously, because we're all assuming that we operate in a non-gnarly environment. 15% tax on the earnings, contributions tax at 15%, and then our pension earnings are tax-free both in the fund and also to us individually once we've hit age 65. CGT, taxed at 10% if the asset's held longer than 12 months, or zero if it's in pension phase. Regardless of how big the fund balance is, that's how tax works in a super environment. Once we hit 1 July, then everything still applies as is. Of course, that'll lead us into the budget conversation a little bit later. However, for those with more than the $3 million, then we're going to have an extra 15% on the amount above, on the earnings above 3 million, and a further 10% on the earnings portion above the 10 million amount. So whilst pension funds will still have exempt current pension income, that income will be measurable with regards to the calculation of Division 296. So some key issues there. So it's based on total super balance. So we know that under the previous guise of Division 296, it was ultimately a movement in the total super balance that determined the Div 296 liability. Now total superannuation balance is ultimately the tool that determines whether you are in or out of scope. So measuring the total super balance at both the beginning and the end of the year to work out when it is at its highest, and using that number to determine what proportion of the earnings is then going to be taxed in the fund, and then have that applicable amount of tax calculated. 3 million and 10 million thresholds will be indexed in line with CPI. Again, just reiterating the point I made before, so only the portion above the $3 million is what the tax is applied to. So when we talk about an additional 15%, and when people talk about a 30% baseline, really what they're talking about is only on a small proportion. So, the net tax position for everybody is going to be quite different based on what the actual fund is doing in itself. Again, the 10 million, just to further extend that, is where that additional 10% tax liability is going to come in. And so the question that I won't necessarily answer today, because it's not for me to answer, it's for you to review with your clients, is there a tipping point where people need to consider whether to retain money in super or take money out of superannuation? And that's going to be the $64,000 question. And of course, who wants to put a number on that, because we're talking about tax. Year one, right, 26, 27. So this is law. This comes into effect. So everything that happens inside of super from the 1st of July this year is impacted by Division 296. However, in the first year, we're measuring it based on your total super balance at the end of the year. All right. So that obviously gives a carve out for anybody that passes away in the 26, 27 year. Then when you pass away, your total super balance for Div 296 purposes, your total super balance dies with you, right? Your total super balance clearly doesn't disappear straight away, but for Div 296 purposes, if you've got no balance at the end of 30 June 27, then you're not in scope for Division 296. Beyond that, it's the higher of the opening and closing total superannuation balance that will be utilised to determine where you sit. So what that obviously means strategically is once you hit 30 June 2027, if you've got more than $3 million, you are in Division 296 for at least 2 years, right? You're in it for year one, and then you're in it for year two. Even if you then in the following year get your balance back down below 3 million, because the 1 July balance is going to be above 3, you'll be in it for 2 years. So we've got to understand that, right, from a strategic point of view, that when we're looking at Division 296, it is, for the majority of people, going to be a 2-year strategy, all right? And that's something that we need to get through to people. What, of course, can change is the earnings that are attributable to that individual, and therefore the liability that is then imposed upon them as well. Certain SMSF specific elements with relation to the total super balance, obviously limited recourse borrowing arrangements are subtracted out of the total super balance. So they're not for contribution purposes, but they are for total super balance and Div 296. So we've got the new definition of total super balance that effectively is in place now for 30 June this coming year, which ultimately is not too far away. What's that? 6 weeks away from 30 June. So there's some time pressures on a lot of the conversations that we're having around this area. How's it calculated? It's obviously calculated on the funds. Well, not obviously, because this is the new calculation, but on taxable contributions, taxable income, less assessable contributions, add back the net ECPI, and that gives us our fund earnings. There's also amounts for pooled super trusts. There's also references to non-arm's length income, but let's be very clear. If we're a clear-cut, clean, self-managed superannuation fund, then the 3 key items is going to be the income of the fund minus our assessable contributions plus our net ECPI to give us that Div 296 earnings. We then have to be able to allocate those earnings to the individuals. That will be done for self-managed super funds by an actuary, right? So if there's more than one member in the fund, right, more than one member, then you will be required to get an actuarial certificate, and that actuarial certificate won't give you a percentage. It will give you a dollar value to determine how much income is attributable to that member, and that'll be something that then gets reported back to the ATO for them to be able to create their assessment. So there is going to be engagement with the actuaries, whether that is part of for existing pension funds that have actuarial requirements, whether it's part of the same certificate, whether it's a separate certificate. That's what we need to wait and see the outcomes from the Institute of Actuaries. Again, we're talking 30 June 2027 for that. So, there's still a lot of work in progress in this space. Once we've worked out the income, then we need to know the proportion of the earnings above that large superannuation balance, above 3 million, to work out how the tax is applied. And that's how the calculation works. So when you look at it from a very simple calculation point of view, Sarah got 4.5 million, fund has 225 in earnings. So 225 earnings, all attributable to Sarah. She's the sole member. That's basically a third of the income is above the threshold. So the taxable earnings multiplied by that 33.33% equals 75,000. Div 296 tax is going to be 15% of that, $11,250. All right, so it's as simple as that from a calculation point. The calculation piece is quite simple. It's all the other pieces around it that we have to focus on from our client's point of view. If there's a couple, then we need to get the actuaries involved. So we'll see here that you've got David and Jennifer. David is in scope, Jennifer's not in scope, but the actuary still will need to determine what the attributable amount is. Done it here based on percentages just to highlight it. But the actuary will come back and say that the earnings for David is 119,000. He then has to have his calculation applied on that 119,000. That'll give him his tax liability. So that's the key issues with how the legislation works. As I said, that's no different to what I presented back in February. So if you want to go back and have a look at the February presentation on the SuperGuardian website, then please do, because that's got far more detail on all those elements in regards to that as well. Key issues: actuarial certificate requirements will be a part of this. LRBA exclusion from total super balance is key. You can pay it from the self-managed super fund via a release authority. Alternatively, you can pay it personally if you've got the funds outside of super. Being in pension does not shelter you from Div 296. Okay, so it shelters you from the 15% fund tax, but not the Div 296 tax as well. It is a member tax, not a fund tax, and we would expect the first lot of assessments in mid-2028. Right, so let's jump into the CGT cost base uplift, all right, because this is the first thing, and this is from a strategic point of view. If we're contemplating the fact that we don't necessarily, or there's no immediate action required from a benefit payment point of view, people are looking to draw down below that $3 million until 30 June 2027. However, the CGT piece is something that's a little bit different, and we have to start thinking about it now, right? Because this is a one-off opportunity, and it's not a one-off opportunity that you can come back and look at later. It's not something that you can adjust once you've done it, right? It is a scenario where if we've got a client if we've got a self-managed super fund that's holding shares right now, we should be looking at the CGT position. So what I'm really suggesting is every single fund that you have should be looking at whether or not they should be making the CGT election. Just got a question there. If we are not aware a client is in scope, e.g. they have super in another fund we aren't aware of, are the ATO going to come back later to ask for the actuary certificate? So this is part of the process that we're a little bit uncertain of in the sense that the expectation is that it could flow like that the in-scope notification is made to the fund, then the fund goes and gets the actuarial certificate. Alternatively, and I suspect probably more cleanly, is that the actuaries will, particularly for those in pension funds, so if it's known, they'll just do the calculation and the attribution. If it's assumed, then, okay, subject to the cost, how much it's going to cost to get the actuarial certificate, it may be worth going to do it. Otherwise, you're going to wait until they're in scope to go and get that actuarial certificate from a timing point of view with the assessment piece. Appreciating that you've got a working group at the moment within the ATO with industry bodies, with industry participants, with administrators, with software providers, working through a lot of these key issues. And there are certainly actuarial representatives in and amongst that working group from the conversations I've had with various members. So with this CGT election, you must make the election by the lodgement date of the 26-27 return, and it's got to be based on the assets held at the 30th of June 2026. So there's a couple of key issues, and again, provided you with a list of all the things that we've contemplated with regards to the CGT election to contemplate with reference to your clients. So only applicable for self-managed super funds. So APRA funds have their different rules around the CGT, and they get various incremental offset amounts as 20%, 40%, 60%, 80%, subject to how long they've held the assets. So this is exclusively a set of rules with regards to self-managed superannuation funds. Question there, does someone receiving a pension, does Div 296 payment from the fund count as part of the annual pension payment? I would suggest straight off the bat, no. Right? There's certainly nothing that's changed from a legislative point of view, but a lot of there are certain circumstances where release authorities count towards issues, but to draw down to pay this tax, it would not count towards the minimum pension. But I take that question a bit on notice as well from a finality point of view, but assume at this position, at this point, that no is the answer to that. It is an all CGT asset election, right? So it's not a pick and choose election with regards to whether or not you increase the cost base. So what you're ultimately saying here is, from a Div 296 point of view, the government have said Division 296 is applicable to all earnings from the 1st of July 2026. So what they are saying is they have introduced a carve-out approach to say we're only interested in the gains that are made from the 1st of July 2026. So what we will do is we will let you reset the cost base, right, of all of your assets, if that gives you a better tax outcome for Division 296 purposes, not for other tax purposes. So this does not change the cost base for any other reason inside the fund, exclusively for calculating Div 296. So it's why the conversation around whether or not to make a CGT election is really, have you told your clients to make a CGT election or not? Or do they have funds primarily in a gain position versus a loss position to make it necessary to make that election? All right. So it's based on 30 June 2026. There's no indexation linked to anything like that. It's purely what is the value at that date? Are we going to upscale all of our cost base to that amount? And are we going to do it by the time we lodge our 26-27? It's a critical decision that needs to be made with regards to the fund. And I'll talk about carry forward losses in a moment there, Ross, as part of the conversation piece. It's a critical calculation that needs to be made, because what you're looking at here is a scenario where And just using this example, and then I'll go into three cases that we use at Smarter for our SMSF day earlier in the year. If you've got a fund and it acquired shares back in 2014 that were cost base of 200,000, now worth 600, and you sell them for 700, right? If you don't make the election, then you're going to pay Div 296 on the full gain, less your discount, right? So less your 1/3 discount. If you make the election, then you're only claiming or you're only paying Division 296 on the $100,000 gain. So the cost base change to 600 means your gain is 100. You then still apply your discounting, right? You still apply your discounting. So you still do your normal CGT calculations, but clearly the Div 296 earnings are a lot lower in that situation. So it's such a valuable tool to consider if you've got any assets that are in a gain position versus those assets in a loss position. So where funds are going to have to make a considered decision is if they've got a balance of a portfolio with a mixture of gains and losses. It's, are they willing to accept or effectively the decrease in the cost base of those losses? Will that be offset by the reset of the gains from a position point of view? That's probably the toughest decision that people have to make. The other tough one is if you've got assets held inside, say, a 1322C trust, you can reset the cost base of the units, but you can't reset the cost base of the underlying asset inside that trust. So that's going to have some talking points for people to consider. And of course, one of the things that people will consider there is whether they should get rid of that asset. Now, of course, if they're looking to do that before the 30th of June, time's running pretty short in that regard. And clearly, if they get rid of that asset from an investment piece, then they've got to recognise that in most of these circumstances, if they're linked to Div 296, that they're not going to be able to get that asset back into the super environment. As far as carry forward losses are concerned, so again, two things to be mindful of here. One is the fund still calculates its tax position based on standard tax rules. So we've got our usual CGT rules where we offset any carry forward losses in that regard to reduce our net capital gain position. As far as any losses are concerned in a Div 296 environment, all they will do is they will reduce the income, right? They will reduce the assessable income in the current year down to nil, but then you don't create effectively any carried forward loss in the CGT calculation or in the assessable income calculation. You don't create any carried forward loss for calculating taxable income. You only go down to nil. You don't have any further benefit. So that's one of the big differences between, I mean, there's enough other differences, but that's one of the big ones in the difference between the old legislation and what was enacted. And that was previously you had the capacity, if your total super balance went backwards, to utilise or create a loss to offset against future capital, against future Division 296. Under the new legislation, all that tax losses can do is mean that you'll have nil assessment in that year, but they are of no value moving forward. So that's something to be mindful of. So if we look at a scenario here where we've got a pension member and a pension member with over $3 million, got a fund situation here where everything is in a gain position, it's going to be a no-brainer there. And of course, in a lot of these situations, these assets were reset for actual CGT purposes back in 2017 with the introduction of the transfer balance cap. So that deferred CGT liability is excluded from the assessable income calculation because it's an old tax liability. It's not a current assessable income amount. So that's actually excluded from the calculation here. But it would make sense, obviously, in this situation for this fund to, to apply the election. What we would notice in this fund is that they hold a residential investment property via a 1322C trust. So what they would be doing there is they would be resetting the units of the trust, not the value of the property. So, there's going to be some issues that arise when it comes time to the activities and actions that they take within the trust. If we look further ahead at a fund who is not in scope, do we make the election here? So here we've got Philip and Michelle. You know, Philip's got $1.9 million in pension. He's got $370,000 in accumulation. Michelle's got just over $1 million mixed between a couple of trisses and accumulation. So neither of them are in scope. They've got a portfolio that is largely in a capital gains position. There is one loss sitting in the fund. So when you look at the overall gain of that fund, or the overall position of that fund, you know, it would make sense to claim the election for this fund, or to make the election for this fund, because you are uplifting for Div 296 purposes all of those, what is it, 10 or so investments that they're currently holding. Yes, the LRBA comes off the sum, right? So that obviously takes them out of scope at the moment, but from a planning point of view, that might put them back in scope at some point when that LRBA is paid off in full. What's it going to do? What's the impact going to be from a fund position? So key issue there to look at is that this is not just about those that are already over 3 million. It's about looking at those funds that are close to $3 million as well. Particularly, Phil's got a pension there. If his pension goes across to Michelle, then all of a sudden she's in scope, right? And once she's in scope, then she's going to potentially be captured by Division 296, subject to the first year analogy of what's her balance at the end of the first year. And let's look at a final scenario. And we had a situation where there was a fund that there was relationship breakdown, the benefits have been paid out, and so they'd sold down all their shares. The only investments that they'd retained in the fund were some gold bullion and cash, right? So if we look at this fund, we're going to go, well, you know, there's not much point in, or is there any point in making the election? Well, we've got a gain there of, what's that, 52,000, no, that's, my maths is terrible there, 56,000, let's go with that, gain linked to that gold. So why wouldn't you make the election, right? Why wouldn't you make the election there to potentially save on a future possibility of Division 296? Now, these clients are young, right? So will Division 296 be around in however many years? Who knows? But do we want to say to clients in 10, 15 years' time, oh, actually, the liability would have been less. I mean, we're probably not going to put our hand up and say it, but the liability would have been less if we reset the cost base of that gold back at that point in time, you know, to a higher cost base. You might have saved yourself, 15% on $50,000 there. So marginal, appreciate that. But for all funds, is it worth doing it? And again, I look at my own situation where my fund 100% is nowhere near $3 million, right? But am I going to make the election? Most likely so, because the investments that I hold, of the majority of them, they're in a gain position, thankfully, and there is, you know, one parcel with a loss, a slight loss. So yeah, to me, it makes sense to make that election. So I think it's something that we need to be mindful of moving forward. That by the 30th of June 27, or by the lodgement date of the 26-27 return. So that's May 2028, right, for a lot of funds. By that point in time, we have to make the election. We can make it anytime, right? Anytime from the 1st of July, you can make the election. There is no approved form yet, right? So you're probably not going to be making the election before there is an approved form. So a question there from Con: commercial property in a fixed trust, can the property be reset in the trust units? So the property is sold for large CGT, the distributed gain is reset. So no, that's a situation there, Con, where we can't reset the property if it's held inside that trust. Only the units that the fund has invested in the trust. That's one of the key issues. So Div 296 and CGT reset, strategically, you know, it makes sense in almost all sets of circumstances to utilize that opportunity that's going to arise. But what people need to be looking at now is, do they want to look at their investments with losses at the minute and work out whether or not they can crystallize those losses for fund tax purposes now to carry them forward, versus having to reset them if there's a gain position? So that's where we start to talk about the strategic elements of Div 296. Death benefits. All right, so CGT is activity we have to act on now, right? And then once we act, we will not act again, right? So the election's got to be made. As I said, it's irrevocable. It's an all or nothing approach, so we can't be selective like we could with transfer balance cap. It's a done and dusted thing come the next financial year. Death benefits is a long-term strategy consideration, and I'm breaking this down. I'm going to talk a little bit first about the death concept, and then I'm going to talk about reversionary and non-reversionary pensions. And what that actually means. But year one, we get the same carve out that we previously had for all years. So under the old Div 296 measure, when the member died, they were not liable for Division 296, right? Full stop. That was the originally announced stuff back from 2023. The new legislation is significantly different to that. And that is that unless you die prior to the 30th of June 2027. So unless your clients die before the 30th of June 2027, and they've got more than $3 million, then they will be in scope. So somebody that has $3 million and passes away following 1 July 27, then they're going to be in scope for Division 296. The other thing is that clearly with reversionary pensions, your pension transfers from the deceased member to the surviving member immediately, right? So your total superannuation balance changes immediately. Now, the balance at the start of the year doesn't change because the death benefit isn't paid until the time of death, but the balance at the end of the year will change. And so in that first year of a reversionary pension, the higher balance will be the balance at the end of the year. Now, that will mean that that person will be in scope, the survivor will be in scope, potentially even in a situation where the original pension, the original member wasn't in scope, but when you add the two amounts together, then they're going to be in scope. Of course, being in that first year, if they do a withdrawal strategy before 30 June of the year of death and get below the $3 million, then they're not going to sit in scope. So there's some significant strategic stuff to be mindful of around that reversionary pension piece, because all members who pass away, right, if they're over at the start of the year, then they're in scope for Division 296, regardless of what their balance is at the end of the year. And that's a key piece, right? Because when you die, your total superannuation balance dies with you for Division 296 purposes, right? Now, I just want to be really clear on that when somebody passes away, their balance reverts to zero for determining highest and lowest balance, right? So determining start of year versus end of the year will be nil, right? So regardless of when they die in the year, their total super balance for that determining factor will always be nil for the end of the year, and it's going to be the start of year balance that's going to be relevant to determine whether or not they're in scope. The kicker is that from determining attributable income, your balance continues to grow, right? So if you have money inside of super and you die and you're over that $3 million, then your assessment is going to be based on the balance at the start of the year to determine the proportion of earnings taxable. But the earnings is going to be calculated based on your balance until you pay the death benefit out, right? So what the government have done, and this is obviously a major frustration issue for the industry, but it's also going to be a major frustration issue from an estate planning point of view, from a tax office point of view, from a collection point of view, from so many other points of view, is the longer it, the concept of if somebody dies, Div 296 dies with them, that disappears, right? But if somebody dies, it means that any income attributable to them after that point will be assessed. So the idea of selling down assets after death does not wash under the Div 296 rules. So any post-death sale of the investments will form part of the fund's assessable income, which will form part of the attributable income to the deceased member up until the death benefit is being paid. So what that ultimately means is that the longer it takes to pay out a death benefit following the death of a member, the longer it'll be until a Div 296 assessment is issued, right? And that assessment is going to incorporate earnings linked to the sale of those shares. And of course, the key issue here is that money has been paid out of super, so there's no more money to be asked to be released from super to be able to pay the liability. The money may also have been distributed from the estate to various beneficiaries, and those beneficiaries might be different to the beneficiaries who receive the superannuation. And so the question then rises, who is liable for that assessment? The reality is the estate is liable for it. This is the piece. This is the uncertain piece. This is the hand pass back from Treasury to the ATO and industry to say how that's going to be treated. So I can't give you that answer because I don't think the ATO have that answer, right? But what we have to be mindful of is that the death benefit, the payment of the death benefit, is the stopping point in determining when income will be attributable to that member. So that's a real sort of issue in the new Div 296 environment for the death of a member. Yes, it's payable based on the account balance at the start of the year and the year they die, but then the earnings can attribute for multiple years after that before an assessment is issued. And so that leads to the reference that I made before about hidden tax, right? And we know this week there's been a lot of conversation, the last couple of weeks, been a lot of conversation around death taxes. Well, to me, the government have stopped hiding that anyhow in regards to nothing is a death tax, right? It's just hidden in everything else. So one, you've got your member with more than $3 million, you're going to have tax assessed on the sell down of investments. So yes, we've got the 1/3 discount for CGT. So let's call it a 10% tax on the gains for selling down those assets. So one, there's fund tax, right? Then you're going to have tax on the death benefit. So you're going to have members where you've got non-tax dependents receiving that death benefit, and they're going to pay somewhere between 50 and 32%, right? So is there untaxed element from insurance proceeds, other things like that? They're going to be hit with tax, PAYG tax on that death benefit payment, right? So that's tax layer number 2. And tax layer number 3 is the deceased, right? So we've got the fund being taxed, right, on the earnings that it generates. You've got the beneficiary being taxed at the tax rate applicable to non-tax dependent recipient, and then you've got Division 296 on the deceased. So 3 layers of tax that are likely to come out of this Division 296 introduction for those people with more than $3 million, and that's something that we have to effectively move on and make sure our clients understand that to effectively get the I don't even know if it's a lesser tax outcome, right? It might just be the quickest resolution for it and the easiest ability potentially for the estate to pay it out. Which comes to the question there: how quickly could we close a super fund for a member, assuming we have time to act before death? It's a little bit of a how long's a piece of string question. It's one of those scenarios. How long does it ever take to wind up a fund if you've got assets to sell down? So the conversation piece comes around what are you going to do with that money. But before we jump into winding people's funds up and doing all those things, we've got to look at the alternatives as well, right? And so I'm going to get to the alternatives in a moment to finish off with. But just having that understanding of where the pension sits. And so, excuse me, the natural flow on from all of this is, well, do we do reversionary versus non-reversionary pension? And I don't want to focus too much on the calculations within the next sort of 3 or 4 slides. I just want to focus on the timing piece, because I said you'll get a copy of the slides and you can have a look at them. But if you've got members who are not in scope and then somebody dies and they are in scope, or the recipient is in scope, reversionary versus non-reversionary is fairly critical, because if you are, so in this situation here, if you've got Mark and Linda, right, Mark's got 2.2 and Linda's got 2.4. If it's non-reversionary, then no member is ever in scope unless Linda chooses to pay a death benefit income stream with Mark's benefits, right? But if Linda doesn't choose to do that, she choose to take his $2.2 million out, then she's not going to be in scope. If it's a reversionary pension, then Linda's going to be up at 4.6 and she's going to be in scope. Now, she has time until 30 June of that year to pay money out and be out of scope, but otherwise she's going to be in scope. So we need to be mindful of that. And that's effectively what option A does. And I've reverted back to Phil and Michelle, who I used in the CGT calculation before, is there's this concept from the attributable earnings point of view, where the earnings, because Philip at this point in time, back in 2027, his balance goes up to above $3 million. So Philip would be in scope and he would have the income attributable to him until the date of death. And then Michelle would have the income attributable to her from the date of death, right? So there's going to be the actuaries will do that calculation to determine when the person receives a benefit. So there's not any ability other than Michelle taking the money out of super for her to avoid that Div 296. Versus if we have a non-reversionary pension, because the money's sitting in Phil's balance, it's going to be determined based on his liability at the beginning of the year and how long it takes him to pay his benefit out of the super fund. So if it takes Philip a long time or it takes the fund a long time to pay the benefit, then income will still be attributable if he was over 3 million at the start of the year, so at 1 July 27. Right? So in this instance, even if he's starting to take money out, takes a lump sum out or whatever, it's not going to change his balance, right? But it is going to have an impact on the amount of earnings the fund will actually pay. So clearly what it means is that there is a scope to say reversionary versus non-reversionary pensions in a Div 296 sense don't get captured under the transfer balance cap concept of going, I've got 12 months, right? 12 months is purely from a transfer balance cap credit point of view. It has no bearing on Division 296. So there is some immediacy with regards to acting, and therefore a question mark around should we look to take away the reversion of a pension? Should we look to restructure pensions to make them non-reversionary, to give trustees time and potentially defer that Div 296 liability for up to 12 months by not paying a death benefit until the next year? Because you've still got your as soon as practical concept to pay a death benefit out. And so particularly if Philip's not in scope and Michelle's not in scope, but Philip's balance, if transferred to Michelle, would put her in scope, why would you do it immediately, right? If you've got time, even under the as soon as practical concept, let's say 6 months, whatever it might be, if you've got 6 months and that takes you into the next year, why would you not wait until the next year to start a pension? So number of key issues to be mindful of there. So what's going to put you in scope? So reversionary pensions is going to potentially put people in scope. Strong investment returns in a good year for those clients near the $3 million is going to put somebody in scope. Divorce settlement, right? You know, let's say someone's got heavy super balance and versus assets on the outside or whatever, and they look to even it up through divorce. All of a sudden, somebody might be in scope there. So again, unlike the other rules where there were debits and credits associated with divorce, it's all going to be around money coming in, right? Rollovers and other things. And so what the question then becomes about is what is an assessable contribution? Now that assessable contribution means you might not have any earnings in the first year, but you're going to have a total super balance above the $3 million. The kicker, one of the big ones, is life insurance, right? So a lot of clients, because we have to consider life insurance and TPD insurance inside super, the issue here is moseying along with a balance under $3 million, have an insurable event occur. Now, if that insurable event is death, for example, and so let's say my fund, I've got 1.5 million and I've got $2 million in insurance, right? I have neither of those things, but let's say that I have it for the sake of the conversation. When I die, right, if that $2 million hits my fund and gets paid out, then I'm not in scope because my balance was less than $3 million at the start of the year and it's less than $3 million at the end of the year, subject to the benefit being paid out. But also because I'm dead, right, the total super balance at the end of the year is zero. So I'm not going to be in scope for death. For TPD, and this has always been one of my bugbears, for TPD, you've got this protection under structured settlement, but you don't have that same protection under TPD. So same scenario, I've got 1.5 million, I get my $2 million TPD proceeds, all of a sudden I'm in scope. If I haven't taken any of that money out and I look to pay myself a disability income stream, I'm now in scope for Division 296. So does insurance push me over the edge or does insurance push a spouse over the edge if that death benefit money comes in, and then you start paying an income stream with it. So we have to be mindful of that. So they're the issues that we need to consider. So there's lots of things that could push us into scope for Div 296 purposes. So let's spend this last 15 looking at the strategic considerations because, well, to be honest, they all changed last week, right? So we had a situation where we got a budget that really hit the external structures that people were potentially looking at from a Div 296 point of view. And it means we really have to go back to the drawing board and work out, subject to the budget measures being passed. You'd think, given that it's high tax level, that the Greens would be relatively supportive of Labor's position. I actually haven't taken much notice of what's been said in the last week because I like to wait until we see legislative changes come in and actually be approved before I speak too highly of them. But I want to focus on this because it is conceptually important for us. So when we look at our clients from a matrix point of view, you've got those clients that are under 60 with less than $3 million. They're either not a problem because they're never going to be there, right? Or they might be a problem because of contributions going in and other things. You've got those clients under 60 with more than $3 million, right? And they're young. Well, that's a problem that they ultimately can't solve, right? They're going to have a Div 296 liability if they can't withdraw their benefits, right? So it's not a bad problem to have necessarily, having significant super invested prior to age 60. And potentially the closer they are to 60, the closer they are to being able to fix it, appreciating that they have that 2-year window where they're likely to be liable for tax. If they're over 60, 65, again, 60 to 65 with the TRIS style strategy, but over 65, it's not a problem with regards to take it or leave it, be involved with Div 296 or get out of Div 296, but then understand the tax ramifications of money sitting outside of super. And same with you've got more than the $3 million. Yes, you're in scope, but you're in scope and you've got solutions, and that solution is conditions of release. So there's opportunities. So when we're looking at our strategic things that we need to consider from a base level, first thing, make a CGT reset election, right? So minimize Div 296 by making that election up front. Consider withdrawing from super. So that's a piece that said, I'm not making any recommendations here whatsoever, but people will look at it and go, well, what assets do I already have outside of super? Is there any value in me pulling money out where potentially I won't generate as much income, particularly if they're super rich and external asset poor, right? Then that might be a worthwhile strategy in that regard to consider. Certainly review your death benefit arrangements from an estate planning point of view. So the potential restructuring of reversionary versus non-reversionary. Again, we're only talking about those clients where they absolutely want to avoid the scenario of people being hit by Division 296, but they at least need to understand what the ramifications are. Reviewing the fund's investment strategies. It's almost a throwback to the old reasonable benefit limits where people had high growth strategies and then low growth strategies when they were over the RBLs back in the day. It's that kind of consideration, but also there's nothing restricting from a SIS point of view member-directed investment strategies as well. So that impacts your total super balance. The income from all the assets is going to be attributable regardless of what you do inside the fund. From a pure calculation point of view, you might get income attributable to you that otherwise shouldn't be, but you can still do member-directed investment. So that's a consideration there. Obviously, your pension and drawdown strategy. So increasing your drawdowns to get below that $3 million mark. So inevitably the liability decreases as people's money comes out of the super environment. But also, we've been speaking for years about the opportunity in getting to 75 and making more contributions. Well, whilst most people in a non-concessional environment aren't liable for Div 296 immediately because they're going to be under 2 and 2.1 million, combined with their spouse, they're going to be over that 4. And so there's that consideration then of, again, reversionary versus non-reversionary, but also things like downsizer, CGT cap contributions. These things that aren't measured against total super balance are going to have a relevance there. So what were our options? Well, until the 12th of May, we would look at obviously option 1, which is still possible, retain the money in super and be subject to Division 296. Option 2 is the one now that we have to look very closely at in light of the budget announcement. So transfer any excess amount, whether it's like the excess of 3 or the excess of 10, transfer it to the personal name, transferring it to the family trust or a corporate entity or to some other investment vehicle there. Or then look at things like gifting, primary residence, making improvements, given that is still the one CGT-free asset and the asset test exempt asset, whether or not people look to put more money into their primary place of residence, or whether there are other options there. So that was our thought process up until, well, probably pre-budget announcements when we knew what was potentially coming. But now we know that we've got CGT reform, with the big issue being the removal of the 50% and moving to an indexation scope. So that coming in, right, from the 1st of July 2027, where your minimum CGT is going to be 30%. So that's a key issue, given that self-managed funds will retain their discounting, right, versus other entities won't have that discounting applied to them. So there is a real income issue linked to wealth, where you're holding wealth inside versus outside. And again, if all of your tax position outside of super is sitting at in that 30% bracket, right, then moving money outside of super and retaining it in 30% is going to be much of a muchness versus Div 296. But certainly if someone's in the higher tax rate or higher tax bracket, then it's not going to be an attractive option to move that money out of super. And of course, the big change was the change to discretionary trusts and having that minimum tax on discretionary trusts, so 30% tax on the income. Also, not subject to the CGT discounting, so indexation there, so a minimum tax rate on that as well. It means that the conversation piece, which previously was around taking money out of super and from a Div 296 point of view and putting it into a discretionary trust, becomes a far more considered conversation piece, because we don't have income splitting and those sorts of arrangements available from 1 July 2028. So noting that we've got an extra year there to contemplate it, but it is going to be an issue for people. So, it was the strategy. It was a strategy a lot of people were talking about before the budget. Post the budget, it's less likely to be attractive, particularly for those between $3 and $10 million, okay, where you're talking about a base rate of 30%, but not really 30%, because you might have the fund only paying zero and just paying 15% Div 296, or even if the fund is paying, say, 10% average tax rate, then you're only looking at 25 versus 30. So there's issues to consider there. So what I've done, or what we've done at Smarter SMSF, is we've created a number of tools, and I will finish off and just run very briefly through our Div 296 hub, because as I said, a lot of this has been fairly sort of thrown at you at a fast pace here today. But we've been putting some post-budget calculators together to look at Division 296. So these aren't yet available on our website, and again, when they are, they'll be made available on a subscription basis. But we've done some modelling on this and continue to do some modelling on, for somebody with a total super balance of, say, in this instance, $8 million, and they look to pull that money out and put that $2 million into a family trust. We've done the modelling on that with some assumed earning rates, and you can adjust all these things with these calculators and functions that we're creating there. But when you go through that process, ultimately the end result is leaving the money in super with $8 million versus pulling $2 million out tax-free and transferring it across to a family trust. Leaving it all in super puts you in basically a $16,500 better off tax position. So, whereas for a lot of people that conversation around those just over 3 million was probably likely to say, keep it in super. I think the trust changes definitively make that, or give us that capacity to definitively say money is better off from a tax point of view inside the superannuation environment. The caveat to all of this is tax on death, right? So again, subject to the payment of benefits. So there has got to be a time when the money is coming out of super, particularly in light of the second death benefit, where people go, okay, we need to pull that money out and potentially look to invest it or look to gift it at that point in time. So a lot of pre-death planning is likely to be part of the conversation piece. But that's a critical thing for people to contemplate. Probably when we look at our modelling and where it's a little bit different is those with more than $10 million, right? So a lot of the early modelling done once the legislation for Div 296 came in was to say that it didn't make a lot of sense in a lot of instances to keep money inside of super if you could push it across to say the family trust from a Div 296 point of view because of the tax benefits. What we've looked at here is someone with 15 million, right? So we've gone well above the 10, and we've said, okay, well, let's assume, or let's do a removal of $3 million of that, and put that $3 million sitting into a trust. So again, we've looked at a couple of different scenarios under the modelling point here, and what this shows is that at that level, right, at that level of pulling 3 across, so bring our super balance down to 12, paying Div 296 tax on the earnings inside the super on the 12, right, and then paying tax through the distributions from the income with the family trust, makes the benefit about $8,000 greater benefit for that money sitting inside a split entity super and the family trust. So then you've got to weigh up, okay, in a $15 million portfolio, what are the costs associated with that transaction, weighing up against the 8,000. So there's going to be that break-even point where moving the money across is going to be beneficial for people. What are the costs associated with making that move? And of course, what is the great caveat being the death benefit piece? And so ultimately what a lot of this does is it brings the death benefit planning conversation forward a lot earlier, and people are going to get caught out, obviously, and people will pass away, and tax will be inevitable. But where we can plan having that conversation around paying pre-death benefits and distributing money beforehand when it's tax-free to the individual is something to consider. But when we're looking at moving money out of super, we've got to look at the associated CGT, right? Is there tax inside the fund to do that transaction? And then, what's the tax for the investment sitting outside of super? So a lot of things to take into consideration with that one. So what I want to finish off with is the things that you need to contemplate now. So you've got to review the assets held personally or in a trust, right? Because from a budget point of view, if you're looking at saying, okay, well, we want to move away from the discretionary trust situation, you're going to have a 3-year window, right? From 2027. You're going to have a CGT exemption window for selling those assets out of the trust. So people are going to look to utilize that there. From a contribution point of view, are you going to look to transfer some of those assets into super potentially from a trust point of view? Are we going to do that while we've got the 50% CGT discount from an individual point? So before we lose that on existing assets as well. So a number of things to contemplate with regards to the whole trust piece of operating, but also important to understand all the dates that we need to know. So from a Div 296 point of view, when it takes effect, when our CGT election is due, when we expect to get our first lot of assessments. It's all important to understand that, and all the dates linked with the potential federal budget changes, right? So the new CGT rules commencing from the 1st of July 27, the trust rules changing the 1st of July 28, and then the 30 June 2030 for the CGT relief to close on moving trust assets. So that's a lot for us to get through in an hour, but I wanted to get through as much of that as I could. And I said you'll get a copy of the presentation, so you'll be able to look closely at it. We've provided a bit of what happens next. So what do you need to be doing with your clients now? Reviewing total super balance, obviously, getting a hold of that information, assessing the CGT position for clients, doing some Div 296 modelling on what their tax liability would be based on their current balances is beneficial. Reviewing their estate and insurance arrangements also will help, because again, it's not necessarily about that first death benefit. It's going to be that second death benefit that potentially creates an issue. Okay, so how can we help? We've created a Div 296 tax hub. It's live now. Within our tax hub, we have a whole heap of frequently asked questions, about 50 questions there on 10 different topics. We've also got the standard copies of the legislation, but we've provided for certain members calculators and tools, various fact sheets, and then client and advisor resources. So letters and communication that you can do to send out to clients to communicate with them around Div 296. So, whether they're in scope, whether they're potentially going to be in scope, CGT explainer letters. So all these sorts of things we've made available for people to be able to utilise. And we've built and are building calculators. So we've got a Div 296 tax estimator. So that's, again, from a modelling point of view that people can look to use. We've got a CGT reset calculator. And then we're going to look at the survivor modelling with regards to money inside or outside with regards to death benefits. So we've done a lot of work, obviously, since February on these issues, because it's fairly significant from our industry point of view. Part of it's free. You don't want to put in all the hard work for nothing. So part of it's free for those that are members of Smarter SMSF, either as document providers, like you do document, or through CPD. Then you can get access also to our fact sheets, the letters, and our calculators. Otherwise, we do have a purchase opportunity for people to look at. But we're more than happy for people, if they've got questions in regards to this topic, to reach out and ask questions. So yeah, that's strategically all the things to think about. Our next webinar coming up in June, I think Josh is going to be joining me, hopefully, on the 11th of June, and we're going to do a bit of a 30 June checklist. So there'll be a couple of things. We'll probably review the CGT reset stuff as well there. But obviously a lot of the other things that go into end of year planning from a self-managed superannuation fund point of view. I sort of put up there, we do have a masterclass coming up. Aaron Dunn and myself run 3-hour masterclasses 3 times a year. And given the interest in Div 296, we are running our next one in June on Div 296. So you can always jump onto our website and have a look at that if it takes your interest. But I think I've gone through and answered all the questions. The last one there, could I withdraw excess above 3 million, bring in 3 adult children member accounts? Look, if you want it. I mean, I don't know how the kids will get they'd only be able to get the million in over time. So the withdrawing amount, the recontribution strategy is clearly a strategy that people are going to utilise, right? Spouse equalisation, contribution splitting, these are all strategies that are legitimately available when people have met conditions of release. Gifting to children is certainly an area that people will contemplate. Getting those kids into the super fund, obviously the key is the money has to go out first before it can come back in, and then it's going to be subject to where they're sitting with total super balance and that from a contribution point of view. But the increase in the non-concessional caps, that's going to help a lot of people. Forget this year, but over the next 2 years, the ability to basically put in $500,000 as a couple. So we're balancing out here Div 296 versus discretionary trust stuff as well. So it's finding the appropriate balance for people and where they actually sit. So thank you for attending. CPD with a copy of the presentation will be sent out from SuperGuardian. So thanks for attending, and I look forward to catching up with you all at the June webinar. Thanks a lot.